Welcome back to the Black Wealth Creator Podcast, where we help uplift the Black community through financial education. Let's talk about stocks. I want to make this disclaimer. There are seminars, there are classes, there are whole professions centered around stocks. So this can be a very convoluted topic. It can get as complex as you like, but I'm just going to be super high level in terms of what we talk about. I have 3 objectives today: what stocks are, where you can purchase them, and why they are important. What are stocks? Let me read the definition. Stocks, also called equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a portion of the corporation's assets and profits equal to how much stock they own. Units of stocks are called shares. So let's break that down. A stock is a percentage of a company. By owning a stock, you own a percentage of the company. So let's say we had a candy bar that had 10 pieces. If you broke that candy bar in half, if you took those 10 pieces, each piece together makes the whole candy bar. But separately, they would be considered shares or stocks or pieces of the candy bar. So that's pretty much what stocks are. If you put them all together, that makes up that whole entire corporation. And that's the overall value of that corporation if you add all the stocks up together. But by owning a percentage of it, then you are indeed owning that corporation. So let's take McDonald's. If McDonald's had, hypothetically speaking, of course, 100 shares to equal up their whole I'm sorry, I laugh because it's so crazy to think about. But if they only had 100 shares, it equals up all of their $1 billion company. So that's why I laugh. Like, it's way more McDonald's stocks out there. But if there was only 100 of them, each one of those 100 stocks is worth about, if we're talking about a $1 billion company. So you take $1 billion and you divide it by 100, and we're looking at about $10 million per stock. So this is very unrealistic. And it's not accurate at all in terms of that being that. A lot of times we're talking stock prices are relatively low enough for a person to purchase them. So that indeed is what a stock is. It's just a percentage of the corporation. Where to buy stocks? First of all, stocks are bought and sold on the New York Stock Exchange. There are other stock exchanges like the NASDAQ and the New York Stock Exchange. So there's other stock exchanges, and then there's global stock exchanges as well. So you can find out more about those as well just by doing a little research. And you can normally buy them at stockbrokers, and there are a number of stockbrokers. I mean, I wrote down a couple of them. You got like Fidelity, E-Trade, TD Ameritrade. So you got a whole lot of places you can go and buy stocks. You can go to these numerous places to buy stocks. And back in the day, like, you used to get charged every time you might make a sale or every time you might make a purchase of a stock. So they would call that commission. There was a lot of commission fees back in the day, but nowadays you can buy, and there might be a fee for selling, but I know you can buy all the stocks you want nowadays, and it's like normally like $0. You just have to have an account with that TD Ameritrade or Scottrade or E-Trade. You've seen the commercials. So you just have to have an account with them, and then you can start investing in the stock market. Why do we buy stocks? What's the point of buying stocks? Like, what's the point? Why is it important to buy stocks? So stocks are investments. Stocks are investments into companies. So companies normally have an IPO, which is called an initial public offering. And in this IPO, they value the company, see how much the company's worth, and you know the like the New York Stock Exchange, they're consultants and stuff. They'll value how much the company is worth, and they'll put out a stock price. And so the company then is skyrocketed because they put out a stock price, and people just buy up to the value of that company. And so that company just got an influx of money from people, so for the value of their company. So that's why a lot of industries look to, that's why they call them like initiate their IPOs, because you might take like an Airbnb. I think when they did theirs, it was like they were valued so high, and so it's just an influx of cash coming into that company, and they're able to do more research, or do research and development, or research and design, R&D, or they're able to like put new plans in place, do new marketing, like all these things come into play because now you have the money coming in from those stocks and stuff. And so that's the whole point of as to why companies do the stocks. Now on our end, like I've said before, you want your money to work for you. So the stock exchanges historically generated returns of about 10% over the last 100 years. This is really high percentage. So that's why people will like invest in the stock market, because it is an investment. So like I've told you before in some of our other videos, you want to pay off debts first, and then you want to increase your saving or bulk your saving, and then you want to invest. Now you can do this, you can invest at any point. Some people try and make a living off of doing the stock market and try and turn a quick profit and stuff like that, but that's not the general purpose of a stock market, because businesses come here to get money to help grow their business. And so it's not the general purpose of the stock market. I mean, some people do it and make a lot of money doing it, but that's not the general purpose of the stock market. The general purpose of it is somewhere to put your cash, or put your cash and just let it grow for the long term at 10%, which is amazing. So if you're putting in $100 a month into the stock market, and that 100 is growing, so it means like every month your $100 is actually $110. So at the end of the year, when you're talking about $1,200 that you put in, it's actually up to $1,320 that's actually in the market if you're talking about growth. Now this is if you leave it in there and you let historical numbers take root. You're looking at about 10% return over that 30-year period. Now if you think you're gonna put $100 in today, or $1,000 in today, and get $5,000 out, stock market normally just doesn't work like that. And then you get your outliers, kind of like Google, where they started out at like and this was back in 2004, so it's still about almost 20 years ago. But they started out, and Google's a huge tech company. So anyway, they started out with $52.53. That's what their IPO, that's what they came in at, $52.53. They are now worth $2,700. So that within the last 20 years. So that's crazy growth. This is important, is that why your money is growing, that business is getting larger as well. And so the price of your stock kind of goes up. And so this is why you may hear people talk about, well, the stock market is down. What they mean by that is that the price, or they say my stock went down. That just means like the price of your stock got valued a little bit lower today based off of something that the people running the business did. Let's say like the CEO resigned, and he's a really good CEO. So you might see the stock take a dip, but that doesn't mean that you should pull out. I was looking at an article, listening to a video today, and it said that black people are 7 times more likely to pull out of the stock market than any other race. And it's understandable. Like, we don't trust banks. We don't trust, because we have historically been done wrong in those institutions. So you get that, a lot of that going on. But you'll see like it'll dip, and then black people pull all their money out, where other races may leave their money in, and then they'll ride the wave, the financial wave. And then before you know it, okay, and then some people, like some people, while it's going down, they continue to buy. And so you're buying stuff low because historically the stock market always rises. Like, historically it always rises. So you just ride the wave. And so what you want to do is buy low, sell high. but you just ride that wave if you're thinking about selling. If we're talking about individual stocks, so you just ride the wave. Even if it starts to decrease, you just keep your money in there and keep letting it grow. So yeah, this is just the video I want to do on stocks. I kind of started rambling at the end, but I think it's still good information to know. But I do want to reiterate what I came here to tell you about. So number one, what are stocks? Stocks are just percentages of a company that you buy and purchase, that you can buy and sell, those percentages of the company that you have. Two, where can you buy them? At multiple stockbrokers. You can just do a simple Google search of stockbrokers, or you can look into like E-Trade, Scottrade, or TD Ameritrade, and Fidelity. All of those are just some of the off the top that you can go view. And then three, what's the importance of stocks? Stocks are an investment. So this is normally after you've paid off a lot of your debt and after you have a good bit of savings and you just got money left over. This is just helping you, instead of saving at like 1%, you can invest your money into the stock market at a higher percentage of 10%. This has been another episode of the Black Wealth Creator Podcast, where we help uplift the Black community through financial education. Remember, getting money is easy, but building wealth takes time and effort. Anybody can do it, especially you. Be blessed.